What is a profitable strategy and setup for daily options trading? Creating a profitable strategy for daily option buying requires a blend of technical analysis, market awareness, and disciplined risk management. Here's a step-by-step guide to a basic setup for daily option buying. 1. Understand the basics, option premiums. When buying options, the premium is the price you pay for the contract. The objective is for the price of the underlying asset to move favorably, increasing the value of the option. Time decay, theta. Options lose value as they approach expiration, which is particularly important for short-term trades. Implied volatility, IV. Higher IV increases option premiums but can be detrimental if it drops after your purchase. 2. Identify high-probability market setups. Trend trading. Follow the direction of the trend. Options can be bought when a stock breaks out of consolidation patterns, strong support resistance levels, or a moving average crossover. Momentum plays. Look for stocks with high volume and momentum. Stocks with significant news or earnings reports often present opportunities for sharp price movements. Reversals. Set up for potential reversals by buying options when stocks reach extreme levels of overbought or oversold zones, for example, RSI or MACD. 3. Define your setup, time frame. Focus on shorter time frames, for example, intraday or 1-2-day expiration, to take advantage of quick price movements. Technical indicators. Use tools like moving averages, for example, 20-day, 50-day MA, RSI, Relative Strength Index, MACD, Moving Average Convergence Divergence, or Bollinger Bands to identify entry-exit points. Breakout strategy. Watch for stocks that break out of key levels of resistance or support, using an option with a strike price just out of the money, OTM, to capture the breakout move. 4. Option selection. Choose liquid options. Focus on options with high volume and tight bid-ask spreads to avoid slippage. In the money, ITM versus out of the money, OTM. ITM options have intrinsic value and are safer, while OTM options can be riskier but offer higher reward potential. Expiration. For daily trades, consider options expiring within the next 1-2 days to maximize leverage. DT. 5. Risk management, TE3. Limit losses. Use stop-loss orders or mental stops to exit trades if the stock moves against you. Position sizing. Only risk a small portion of your capital, for example 1-2%, per trade to avoid large drawdowns. Targeting profit. Set realistic profit targets, for example 20-50%, and close positions as soon as your targets are hit. 6. News and market sentiment. Stay updated. Be aware of news, earnings reports, or macroeconomic events that can drive sudden market movements. Monitor volatility. Use the VIX index, the fear gauge, to gauge overall market volatility, which can influence option prices. 7. Example. Strategy. Simple breakout setup. Stock selection. Identify a stock in an uptrend using daily and hourly charts. Entry. If the stock breaks above a significant resistance level, buy a near-the-money NTM call option with 1-2 days expiration. Exit. Close the position if the stock hits your profit target or if it falls below a certain stop-loss level. 8. Journaling and review. Keep track of every trade you make, entry, exit, reasoning, and outcome. This will help you refine your strategy over time. Summary. Focus on high-probability setups like breakouts or momentum-driven plays. Choose liquid options and stick to ITM or NTM options for better risk management. Keep your trade duration short to mitigate the effects of time decay. Always have a defined risk-to-reward ratio and exit strategy. Here are a few key aspects that can be expanded upon. A. Technical indicators, RSI, MACD, moving averages. Using technical indicators like RSI, Relative Strength Index, MACD, Moving Average Convergence Divergence, and moving averages can help refine your entry and exit points when trading options. Here's how these indicators work and how to incorporate them into your strategy. 1. RSI, Relative Strength Index. What it measures, RSI evaluates the momentum and speed of price movements on a scale of 0 to 100. It helps identify overbought and oversold conditions. Key levels. Overbought, RSI 70 suggests the stock is overbought and might reverse or pull back. Oversold, RSI 30 indicates the stock is oversold and might bounce higher. How to use RSI for options. Breakout confirmation. If the RSI is above 50 and rising during a breakout, it confirms bullish momentum. For bearish breakouts, RSI below 50 and falling is ideal. Reversal trades. Use RSI divergences to spot reversals. For example, if the price makes higher highs but RSI makes lower highs, it may indicate weakening momentum and a potential reversal. Combine with support and resistance. Look for RSI to confirm a bounce near support or resistance levels. Example, chart. A stock breaks resistance at $100. If the RSI is above 50 and rising, you might buy a call option to capitalize on the momentum. 2. MACD, Moving Average Convergence Divergence. What it measures, MACD, tracks the relationship between two moving averages, typically the 12-day EMA and the 26-day EMA, and includes a signal line, usually a 9-day EMA of the MACD line. Key components, MACD line, the difference between the 12-day EMA and 26-day EMA. Signal line, a 9-day EMA of the MACD line. Histogram, the visual representation of the difference between the MACD line and the signal line. How to use MACD for options. Crossovers, bullish crossover. When the MACD line crosses above the signal line, it suggests bullish momentum. Bearish crossover. When the MACD line crosses below the signal line, it indicates bearish momentum. Divergence, similar to RSI, MACD divergences can signal potential reversals. Trend confirmation. Use the MACD histogram to gauge the strength of a trend. A growing histogram indicates increasing momentum, while a shrinking histogram suggests weakening momentum. Example, a stock is nearing support at $90. The MACD line crosses above the signal line, and the histogram turns positive, signaling bullish momentum. You might buy a call option in anticipation of a move higher. 3. Moving averages. What they measure. Moving averages smooth out price data to identify trends over time. Common types include cherry simple moving average. SMA, the average price over a specified period. Exponential moving average, EMA, gives more weight to recent prices for a faster response to price changes. How to use moving averages for options. Trend, identification. If the price is above the moving average, it indicates an uptrend. If the price is below the moving average, it suggests a downtrend. Crossovers. Golden cross. When a short-term MA, for example 20-day, crosses above a long-term MA, for example 50-day, it signals a potential bullish trend. Death cross. When a short-term MA crosses below a long-term MA, it signals potential bearishness. Support and resistance. Moving averages often act as dynamic support-resistance levels. Example. A stock breaks above its 50-day EMA and starts an uptrend. You might buy a call option if the price stays above the EMA. Combining indicators. For better accuracy, combine these indicators to confirm your trades. Here's how. 1. Bullish trade setup. Prices above a key moving average, for example 20-day EMA. RSI is above 50 and rising but not yet overbought, 70. MACD shows a bullish crossover or an increasing histogram. 2. Bearish trade. Setup. Price is below a key moving average. RSI is below 50 and falling but not yet oversold, 30. MACD shows a bearish crossover or a decreasing histogram, 𝐼𝐶. Practical example, Strangles. Stock XYZ is trading at $120. Scenario, the stock breaks above a consolidation zone at $118. Indicators, RSI, rising above 55. MACD, bullish crossover with an increasing histogram. Moving average, the price is above the 20-day EMA and has just crossed the 50-day EMA. Action, buy a call option at $120 slightly out of the money to take advantage of the breakout. Tips for using indicators. Avoid overcrowding. Use 2-3 complementary indicators to avoid analysis paralysis. Backtest your strategy. Apply these indicators to historical data to see how they perform in different market conditions. Keep it simple. Combine these tools with clear price action strategies, for example, support resistance patterns, for the best results. B. Breakout strategy in depth. A breakout strategy is a popular approach for trading options, as it focuses on capitalizing on price movements that break through key levels of support or resistance, often leading to substantial price movement in a short amount of time. Here's a deep dive into how to structure a breakout strategy for daily option buying. Understanding breakouts. Breakout definition. A breakout occurs when the price of a stock moves beyond a well-established support or resistance level with increased volume. A breakout can happen in either direction, up or down. Key levels. Resistance is a price level where sellers outnumber buyers, pushing prices down, while support is a level where buyers outnumber sellers, preventing the price from falling further. 2. Identifying potential breakouts. To trade breakouts successfully, you need to identify potential breakout zones. Here's how. Chart patterns. Certain patterns often precede breakouts. These include terce-du. Triangles. Ascending, descending, or symmetrical triangles indicate a squeeze in price action before an eventual breakout. Flags and pennants. After a strong move, flagpole, price consolidates in a small range, flag, often signaling continuation in the same direction. Head and shoulders, a reversal pattern that, when completed, often leads to a breakout below the neckline. Cup and handle. This pattern indicates a bullish continuation with a breakout often following the formation of the handle. Support and resistance levels. Use daily and hourly charts to identify clear levels where price has bounced multiple times. A strong breakout will often occur at these points. Consolidation zones. After a strong move, prices tend to consolidate in a narrow range. Breakouts from consolidation zones, for example, range-bound trading, tend to be more explosive. 3. Confirming the breakout. A breakout isn't just a move past a certain price level. It must be confirmed to avoid false breakouts, head fakes. Here's how to confirm. Volume confirmation. A breakout is stronger if accompanied by significant volume. Higher volume means more traders are participating, adding credibility to the move. Price close. Wait for the price to close above resistance or below support in a breakdown before considering the breakout valid. Intraday price spikes can lead to false breakouts if they do not hold by the close. Retest of level. In some cases, the price may break through a level, then return to test it, turning resistance into support or support into resistance. This retest can be a good secondary entry point. 4. Trade setup for option buying. When you spot a confirmed breakout, here's how to structure the trade. Call options for bullish breakouts. If the stock breaks above resistance, purchase a call option to benefit from the upward movement. Put options for bearish breakouts. If the stock breaks below support, purchase a put option to capitalize on the downward movement. Choosing the right option. Strike price. Select a strike price slightly out of the money, OTM, to benefit from leverage but not too far out, as deep OTM options may expire worthless. Expiration date. For daily trading, choose options with 1-2 days until expiration. This increases your exposure to price movements while keeping the cost lower due to the shorter time frame. 5. Entry and exit strategies. Entry. Enter as soon as the breakout is confirmed. In most cases, this is when the stock closes below the breakout level, or after the first significant retest of that level. Alternatively, if you're more conservative, you can wait for the stock to move slightly past the breakout point, increasing the likelihood that it's a true breakout. Exit. Profit target. Set a profit target based on technical levels or expected price movement. For example, you can use measured moves, the height of the previous pattern projected from the breakout point, or Fibonacci extensions to calculate targets. Trailing stops. Use a trailing stop to lock in profits while allowing the trade to run. For example, you can use moving averages or a percentage-based trailing stop. Stop loss. Place a stop loss just below the breakout level in case the trade turns against you. A common strategy is to set the stop slightly below the last support resistance level. 6. False breakouts and how to avoid them. False breakouts occur when the price breaks past a level but quickly reverses, trapping traders. To avoid these, wait for confirmation. Always confirm with volume and/or price closing above the breakout level. Use smaller time frames. On an intraday basis, using 5 or 15-minute charts can help you spot early signs of a false breakout. Monitor market sentiment. Check for broader market trends or catalysts that could invalidate the breakout. For example, sudden news that contradicts the breakout move. 7. Example of a breakout trade. Stock XYZ is trading in a range between $100 and $105. Resistance $105. Support $100. Setup. After several failed attempts, XYZ breaks above $105 on high volume. Action. Buy a call option with a $106 strike price and expiration in 1-2 days. Entry. Enter as soon as the price closes above $105 or on a retest. Profit target. Set a target for $110 using the previous height of the consolidation as a reference. Stop loss. Place a stop just below $104 to protect against a false breakout. Outcome: if the breakout succeeds, the price moves towards $110, increasing the value of your call option significantly. If the breakout fails, your stop loss prevents large losses. 8. Final tips for breakout trading in options. STIASI. Trade high-volume stocks. Stick to highly liquid stocks and ETFs, as breakouts in low-volume names are more prone to failure. Keep an eye on implied volatility. If volatility is expected to spike, for example, before earnings or major news, buying options can be expensive. You might consider breakout trades in calmer markets to avoid overpaying for options. Stay disciplined. Don't chase breakouts that have already run too far. Wait for pullbacks or retests to get a better entry. Conclusion. Breakout trading offers great opportunities for daily option buying because of the potential for quick explosive price movements. By identifying key support resistance levels, confirming breakouts with volume and price action, and employing strict risk management, you can develop a systematic breakout strategy that enhances your chances of success in the options market. C. Option selection, ITM versus OTM strike price. Choosing the right option is critical to success in daily options trading. Your decision between in-the-money ITM and out-of-the-money OTM options, as well as the strike price, should align with your strategy, risk tolerance, and expected market movements. Here's a detailed guide. 1. Understanding ITM, OTM, and ATM options. In-the-money ITM. Call options. Strike prices below the current stock price. Put options. Strike prices above the current stock price. Characteristics. Higher premium, intrinsic value, time value. Lower risk and more likely to retain some value even if the stock doesn't move much. Slower percentage gains but more stable in value. Out of the money. OTM. Call options. Strike prices above the current stock price. Put options. Strike prices below the current stock price. Characteristics. Lower premium, only time value, no intrinsic value. Higher risk as they can expire worthless if the stock doesn't move significantly. Potential for larger percentage gains if the stock moves favorably. At the money, ATM. Strike prices closest to the current stock price. Combines characteristics of both ITM and OTM, with a balanced premium and risk. 2. When to choose ITM options. Conservative strategy. Use ITM options if you want to reduce risk. These options have intrinsic value and are less sensitive to time decay, theta. Small expected movements. If you expect only a modest move in the stock price, ITM options are better as they respond more linearly to changes in the stock price, higher delta. High volatility. ITM options are less affected by changes in implied volatility, IV. In high IV conditions, ITM options might be a safer bet. Scenarios. Strong uptrend with low risk of reversal. Confirmed breakout with steady momentum. 3. When to choose OTM options. Aggressive strategy. Use OTM options if you're targeting large percentage gains and can afford the higher risk of loss. Significant expected movements. If you anticipate a sharp price move, OTM options provide higher leverage and the potential for exponential gains. Solo premium. If you have a smaller capital base or want to reduce upfront costs, OTM options offer a low-cost entry point. Scenarios. Anticipation of a major catalyst, for example, earnings, news, market rally. High momentum trades with sharp breakouts. 4. Choosing the right strike price for ITM options. Select a strike price close to the current price but still in the money. 1. 3 strikes ITM. This balances cost and probability of profit. For OTM options, choose a strike price close to the expected target price. For example, if the stock is at $100 and you expect it to reach $110, consider a $110 strike price. For ATM options. ATM options are ideal if you expect immediate movement but are uncertain about the magnitude. They provide a balanced risk-reward profile. 5. Impact of option Greeks, RC, delta. ITM options have higher delta, 0.60-0.80, meaning their price moves more in sync with the stock. OTM options have lower delta, 0.20-0.40, meaning they require a bigger stock move to gain value. Theta, time decay. ITM options decay slower than OTM options because they have intrinsic value. OTM options lose value quickly as expiration approaches, especially if the stock price doesn't move. Implied volatility, IV. OTM options are more affected by IV changes, which can either inflate or deflate their premium significantly. 6. Expiration date. For day trading. Choose options with the nearest expiration date, same day or 1-2 days out. These are cheaper and move more quickly with stock price changes. For swing trades. Consider options with 1 DL, 2 weeks until expiration to reduce time decay while still keeping costs reasonable. 7. Risk and reward comparison. 8. Example scenarios. Scenario 1, bullish breakout. Stock XYZ is at $100. Expectation. You anticipate it will rise to $110 by the end of the day. Option choice. ITM. $95 call option for steady but moderate gains. OTM. $110 call option for high risk, high reward potential. Scenario 2. Earnings trade. Stock ABC is at $200. Expectation, high volatility and a big move post-earnings. Option choice, OTM, $210 call or $190 put to capitalize on a major move. ATM, $200 call or put for balanced risk. 9. Final tips for option selection, liquidity. Choose options with high open interest and tight bid-ask spreads to minimize slippage. Volatility. Considerations, be cautious of IV crush, sharp drop in IV after news or earnings, which can hurt OTM options. Risk management, limit the portion of your capital allocated to OTM options due to their higher risk. D. Risk management techniques, stop loss position sizing. Effective risk management is crucial for sustainable success in options trading. Techniques such as stop-loss orders and position sizing help limit losses, protect profits, and ensure disciplined trading. Here's a detailed breakdown. 1. Stop-loss orders. Stop-loss orders automatically close a trade when the option price or underlying asset moves against you. This prevents emotional decision-making and helps manage risk. Types of stop-loss orders. 𝐏𝐫𝐨𝐟𝐢𝐭𝐚𝐛𝐥𝐞 price-based stop-loss. Set a specific price level where the trade is automatically exited. Example way does. You buy a call option at $2.50. Set a stop loss at $1.25, 50% of the premium, limiting your loss to 50%. Percentage. Stop loss. Exit the trade when the loss reaches a predetermined percentage of your total capital. Example would. Your account balance is $10,000. Risk per trade 2%, $200. If the trade hits a $200 loss, you exit. Time-based. Stop loss. Close the trade if the price hasn't moved as expected within a set time. Useful for options with short expirations where time decay, theta, is significant. Technical stop loss. Set stop losses based on key technical levels such as support and resistance. Moving averages, for example, exit if the price drops below the 20-day EMA. Best practices. Always define your stop loss before entering a trade. Adjust stop loss levels as the trade moves in your favor to protect profits. Trailing stop loss. 2. Position sizing. Position sizing determines how much of your capital to allocate to a single trade. Proper sizing limits the impact of any one trade on your overall portfolio. Position sizing rules. The 1 to 2%. Rule with 𝐏𝐫𝐨𝐼𝐭𝐚𝐥𝐞. Risk no more than 1 to 2% of your total trading capital on a single trade. Example way. Account balance, $10,000. Risk per trade, 2%, $200. If you buy an option at $2, limit your position to one contract, 100 shares x $2, $200. Volatility-based sizing. Adjust position size based on the volatility of the underlying asset. High volatility stocks options require smaller positions due to larger price swings. Kelly criterion. A mathematical formula that calculates the optimal bet size for a given probability of success. Fixed dollar allocation. Allocate a fixed dollar amount per trade regardless of account size or market conditions. Example 𝐏𝐫𝐨𝐼𝐭𝐚𝐥𝐞. Commit $500 per trade, buying as many contracts as fit within this budget. 3. Combining stop loss and position sizing. Integrate both techniques for robust risk management. Calculate position size. Determine how much capital you're willing to lose. Divide the risk amount by your stop loss level. Example, account balance, $10,000. Risk per trade, 2%, $200. Stop loss per contract, $1. Position size, $200, $1, 2 contracts. 4. Practical example, trade setup. Underlying stock XYZ. Current price, $100. Call option premium, $2.50. Stop loss, 50% of the premium, $1.25. Account balance, $10,000. Risk per trade, 2%, $200. Step by step. Calculation. Determine position size. Maximum risk per contract, $2.50. Entry price, $1.25. Stop loss, $1.25. Contracts to buy, $200, $1.25, 1.6. Round down to 1 contract. Set the stop loss. Place a stop loss order to sell the option if the premium falls to $1.25. Execute the trade. Buy 1 contract at $2.50. Total investment, $2.50 x 100, $250. Risked amount, $1.25 x 100, $125, well within the $200 limit. 5. Advanced techniques, scaling in and out. Start with a small position and add more as the trade moves in your favor. Exit portions of your position at key profit levels to lock in gains while keeping some exposure. Hedging. Use other options to hedge your position. Example, buy a put option to offset potential losses on a long call trade. Trailing stops. Adjust the stop loss level as the trade moves in your favor. Example, if the option premium rises to $4, move your stop loss to $3 to protect profits. 6. Risk management checklist. Before entering a trade, determine your risk tolerance and maximum loss. Calculate position size and set stop loss. Ensure the trade aligns with your overall strategy. While in the trade, monitor the position and adjust stop loss levels if necessary. Avoid increasing position size unless pre-planned, no revenge trading. After the trade, review the outcome and ensure the trade adhered to your plan. Learn from mistakes to refine your strategy. Key takeaways, 𝐏𝐫𝐨𝐟𝐢𝐭𝐚𝐛𥥞 says. Risk management protects your capital and ensures long-term success. Never risk more than you can afford to lose on a single trade. Position sizing and stop losses should be integral to every trade. Momentum plays in volatility trading. Momentum plays in volatility trading in-depth guide. Momentum and volatility trading strategies are popular in options trading due to their potential for quick, significant gains. These strategies capitalize on sharp price movements or fluctuations in the underlying asset and leverage options for enhanced returns. Here's a detailed breakdown. 1. Momentum trading. Momentum trading focuses on identifying assets moving strongly in a specific direction, often due to news, earnings reports, or technical breakouts. The goal is to ride the wave until the momentum slows or reverses. Key features of momentum plays: high volume. Look for stocks with increased trading volume, signaling strong interest. Directional trends. Use technical analysis to identify upward or downward trends. Catalysts, news, earnings, or major announcements that can sustain momentum. Steps to trade momentum with options. SAS. Identify momentum stocks. Use stock scanners to filter stocks with high relative volume, 2x or more than the average. Strong price movement, for example, 2% daily change. Check for breaking news or upcoming catalysts. Select the right option. item options. Higher probability of profit. Lower leverage but more stable in value. ATM or OTM options. Greater leverage, higher risk-reward potential. Ideal for strong sustained moves. Example, 𝐏𝐫𝐨𝐼𝐭 stock XYZ at $100. Expectation, move to $105. Choice, buy $105 strike calls if you want higher leverage. Use technical indicators. Moving averages. Crossovers of shorter moving averages, for example, 9-day, over longer ones, for example, 21-day signal momentum. Relative strength index, RSI. RSI above 70 can confirm bullish momentum. Below 30 confirms bearish momentum, HE. Volume, rising volume confirms strength behind the move. Manage risk. Set stop-loss orders based on key levels. For example, 50% of premium or technical support levels. Use trailing stops to lock in profits as the momentum continues. Example of momentum trade, stock ABC is at $50. Catalyst, strong earnings report. Trade setup. Buy $55 strike calls for $1.50 with an expiration 1 week out. Risk, $150 per contract. Target, if ABC reaches $57, your calls may increase in value to $3.50, giving a profit of $200 per contract. 2. Volatility trading. Volatility trading focuses on price fluctuations rather than direction. High volatility increases option premiums, making strategies like Straddles or Strangles attractive. Conversely, low volatility is ideal for selling premium through credit spreads. Key features of volatility trading is 𝐷. Implied volatility, IV. Key metric for options trading. Rising IV inflates option premiums while falling IV deflates them. Non-directional. Volatility trading doesn't require predicting price direction, just magnitude. Catalysts. Major events, earnings, Federal Reserve announcements often lead to increased volatility. Strategies for volatility trading. Straddle, TT. Buy. Buy a call and a put option at the same strike price and expiration. Profitable if the stock moves significantly in either direction or IV rises. Example, 𝐏𝐫𝐨𝐟𝐢𝐭𝐚𝐛𥥥 Stock XYZ at $100. Buy $100 call and $100 put. Cost $2.50. Call $2.50, put $5 total. Break even above $105 or below $95 by expiration. Strangle buy. Buy a call and a put with different OTM strike prices. Cheaper than straddles but requires larger moves to be profitable. Example, 𝐏𝐫𝐨𝐼𝐭𝐚𝐥𝐞 Stock XYZ at $100. Buy $105 call and $95 put. Cost $1.50. Call $1.50. Put $3 total. Break even. Above $108 or below $92. Iron Condor sell. Combines a bull put spread and a bear call spread. Profitable when volatility remains low and the stock stays within a range. Example, 3 takeoff stock XYZ at $100. Sell $95 put, buy $90 put, sell $105 call, buy $110 call. Collect premium $2. Profit if XYZ stays between $95 and $105. Calendar. Spread. Buy a long-dated option and sell a shorter-dated option at the same strike. Profitable if IV rises or the stock remains near the strike price. Example, 𝐏𝐫𝐴. Stock XYZ at $100. Buy $100 call, 1 month out. Sell $100 call, 1 week out. Clout. How to trade volatility. Measure IV. Check IV using your trading platform. Compare IV to its historical average, IV percentile/rank, to determine if it's high or low. Look for catalysts. Earnings, product launches, or economic reports. Higher IV expected before events, lower IV after IV crush. Choose the right strategy. High IV, sell options, for example, credit spreads, to benefit from inflated premiums. Low IV, buy options, for example, straddles, strangles, to benefit from potential volatility spikes, ease. 3. Combining momentum and volatility. Momentum and volatility trading can complement each other. Momentum with high volatility. Use OTM options for large percentage gains. Volatility with no directional bias. Use straddles or strangles during uncertain periods. 4. Risk management for momentum and volatility plays. Position sizing. Limit your capital allocation to high volatility trades to avoid large losses. Time decay 𝐏𝐫𝐴. Be aware of theta when buying options. Time decay accelerates as expiration approaches. Adjust for IV changes. Monitor IV. Avoid buying options with already inflated IV unless you expect continued volatility. Example trade earnings play plan. Stock XYZ is at $150. Expectation, high IV before earnings, large move expected. Trade setup, buy a strangle, $160, call for $2, $140, put for $2, cost $4. Break even, above $164 or below $136. Outcome. If XYZ moves to $170, the $160 call could be worth $10, yielding $6 profit, $600. There are more videos and playlists if you would like to deeper dive into any points. Please check it out.